For more on what's moving markets, I want to bring in Jay Hatfield, CEO of Infrastructure Capital Advisors. Jay, it's great to have you on the show today. And a lot of questions that I think our viewers and investors might have right now. What would you tell them as it pertains to stocks?
It's Kristen. It's great to be on. Well, we're probably one of the most bullish strategists out there. So we have a 5750 target on the S&P, and we think actually the risk to that target is more to the upside than downside. And we also have a unique view that bolsters that. You probably have heard the saying, follow the Fed. Well, we think the saying should really be follow the ECB and the Fed. So ECB, European Central Bank, and that's led by President Lagarde. And she's made it very, very clear, both in interviews and the last press conference, that they're absolutely going to cut rates in June. So that should drive global bond prices higher, global equity prices higher, and also be deflationary for our economy and allow the Fed to cut in July. So we're looking for a summer rally. We think the market's probably going to find a bottom somewhere around here, but we are hyper bullish.
Interesting. Now, within this rally that you're projecting, Jay, are there certain sectors, even stocks, that you think are going to lead the way?
Yes, and of course, this would have been a little bit more insightful last week, but we do think that the biggest beneficiaries of this bull market are going to be the investment banks. So and the pure investment banks, so not what I would call banks. And the reason for that is, we've already seen a huge increase in fixed income underwriting. The equity calendar is building, and eventually we'll have M&A accelerate. And that feeds the rest of the investment banks, their trading operations, their wealth management. We already saw that, though, unfortunately, but we do think that trade will continue all year. And we are cautious about the banks because there's pressure on net interest margins and also credit and their balance sheets. But if you really want a bull market stock, it's these investment banks.
Interesting. Okay, good to know. And that's even despite some of these bank results, huh?
Yeah, definitely, but you want to be in the ones that don't have exposure to net interest margin, because that continues to be under pressure because consumers are ratably moving the money out of low yielding accounts into treasuries or into better yielding CDs. And so that's putting pressure on many banks' net interest margin. And it could even get worse if the Fed cuts or when the Fed cuts rates, because the returns on their assets go down, but their liabilities may be pretty sticky in terms of the cost. So we just don't want to be exposed to that net interest margin. You saw some pressure on Bank of America and JP Morgan because of constraints on their net interest margin.
Do you think that the ECB, Jay, to your point earlier, you expect the ECB might lead the way in terms of these rate cuts, perhaps followed by the Fed in July? But do you think that the data in Europe does warrant rate cuts by their central bank?
They really should have cut last meeting. It's incredibly obvious there. They don't have archaic ways of calculating inflation like we do. So their inflation is dropping dramatically. Their headline CPI is already 2.4. We're actually forecasting it goes down to 1.6 by the time they have the June meeting. And they have economies, obviously they have many, many economies that are already in recession. So it's really mandatory they cut. It's not judgmental at all. Whereas the Fed cut is more going to be preventative, so we don't have a recession probably coming from the housing sector. But if you look at the data in Europe, like anybody would conclude you have to cut rates sooner rather than later.
Interesting. So in terms of where we are in the cycle for investors, Jay, who are watching and wondering perhaps, what kind of risk level to apply to their own portfolio, their own investments, what would you say?
Well, I think it's important for investors to recognize that just getting 4 or 5% on your short-term money market fund might seem attractive. But if you miss a rally off the bottom, and we think we are coming off the bottom, you're going to miss. Normally, stocks return about 10%. We could get 15 to 20 this year and maybe another 15 the following year. So you really want to, if you believe our scenario of rate cuts driving the market higher, then we would definitely counsel investors to take money from their short-term accounts, put them into fixed income, particularly preferred stocks. And we run a large preferred stock fund, but also high yield, so slightly riskier fixed income. And then also get the money to work in the market. Probably most investors have a lot of exposure to tech, but in these value sectors like the investment banks or other yield securities, large cap income stocks like we have in our ICAP ETF, those we think have underperformed and will do well when rates drop. And also small caps are likely to outperform if rates are dropping.
Mm-hmm. So we might get, it sounds like, per your projection, at least one rate cut from the Fed in July. Do you expect that more rate cuts would be on the table, or do you think that some of the Fed commentary that we've heard these past few weeks is more on target, that should be a more fluid situation?
Well, we think there'll be 2 to 3 cuts. There should be probably 3 to 4, because really inflation is contained in the U.S. It's about 1.5% right now, core PCE. If you substitute in market rents for the archaic way we calculate it in CPI, and it is 42% of CPI, so it's important to focus on it. But instead of using this thing called the internet, you may have heard of, the BLS does a survey, the organization that prepares it, and they only update it every 6 months, so it's kind of delayed. So inflation's already contained. Unfortunately, we have a rigid Fed that's going to look at just the reported number, but we are forecasting that reported number will gradually drop and will allow at least 2 rate cuts this year.
Interesting. Jay, what else do you think our viewers need to know as they look at their investments right now?
Well, I think it's also important to recognize that we have a little bit pullback, about 4 or 5%, but that it's usually attractive to be invested during earnings season, which, if you've outlined, there's been a lot of strong earnings reports. So we do think the market will stabilize in the short run. And so we wouldn't, we'd advise investors to not overreact to these little downturns that occur usually when we're in an information gap, when earnings aren't coming out.
Jay Hatfield, we appreciate the time. Jay's the CEO of Infrastructure Capital Advisors. Thanks again, Jay.